All right, hello, and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer: nothing in this podcast or any of our other material should be taken as investment advice. James and I could have positions in any of the stocks we may mention today, and we reserve the right to change those positions at any time. So make sure to always do your own work and consult with a professional before making any investment decision. With that being said, the topic of today's podcast is going to be EOS Energy. So we made a video about Eos Energy a few months ago, but for those of you who aren't quite familiar with the company, basically their business model is that they use a certain zinc-based technology to create rechargeable batteries for the purposes of mass storage. And so the business case for this is that they claim that this technology is much more cost effective compared to traditional battery technologies that are based on lithium, because the cost of the materials is going to be much less. And so the use case for these zinc-based batteries is typically large-scale energy production type applications. So if you think about like for renewable energy generation, sometimes when the wind is not blowing or the sun is not shining, you don't have energy generated by these renewable sources. So you need to ideally store the energy somewhere when the wind is blowing and the sun is shining, so you can use it at night and when the wind is not blowing. And the idea is that these zinc-based batteries are cheap enough that you can do this at grid scale, even though they are not as efficient or as have as much capacity as the traditional lithium-based technologies. Financially, this company is doing very poorly. So their revenue is extremely low, increased significantly as a percentage in the last quarter, but still made only $25 million in the entire first half of 2025. On top of that, their operating losses are expanding as they try to increase their production. And because of this, they've had to raise many rounds of diluted funding over the course of the past few years in order to fund their massive losses. So a little bit into why the business model is not working. They're failing to generate meaningful revenue, only $15 million of revenue in the most recent quarter. And that was a significant increase over previous quarters. And these issues have been caused by a number of things. So they've had supply chain issues, which only recently have been resolved. But more importantly, the competitive landscape of the entire business strategy has become much more difficult in recent years. So back in kind of 2021, around the EV mania, lithium prices soared due to demand for lithium batteries for EVs. However, since that peak around 2021, 2022, lithium prices have tanked as more supply has come online, which has made traditional lithium-based batteries much, much cheaper. And so now, because the price of lithium has gone down so much, EOS's value proposition of zinc-based batteries being using a cheaper material is no longer nearly as attractive versus lithium battery packs. And so compared to other large grid scale battery manufacturers like products sold by Tesla, EOS's battery products are no longer have the value proposition to be viable to customers. And so with that being said, I'll toss it over to you, James, to talk about EOS's most recent quarter.
Yes. So as Ryan just explained, in the past, EOS was struggling to generate significant revenue, partly because they said they had all these supply chain issues, which limited their production. And if you just look at the charts of EOS's stock price, the company went public by merging with a SPAC back in 2020. So the SPAC price was $10 per share. Over the next few years, as the company had all these supply chain issues and failed to generate meaningful revenue and was losing a bunch of money, the stock price declined down to almost nothing. So back in like January 2024, the stock price went as low as like less than $1, and it looked like the company was headed towards bankruptcy. Since then, so over the past like year and a half, the share price has surged, increasing more than 700%. And the reason why the share price has increased so much is because they provided guidance saying that their revenue would massively increase in 2025 because they have they were finally able to resolve the supply chain issues. So specifically, they had given guidance that for the full year of 2025, they expect to achieve revenue in the range of $150 million to $190 million. And this is indeed a huge increase because in the entire year of 2024, they only generated $15 million of revenue. So they have given guidance for their revenue to increase tenfold in 2025. And that has created a lot of excitement, and that's why the stock price has increased so much. Now, while their revenue is increasing in recent quarters from a very small base, another problem is that their gross margins are extremely negative. Now, they have bragged, so this is a slide from their Q2 earnings presentation, and they bragged about, oh, see, our revenue increased so much. In the first half of 2024, they only made $8 million of revenue. And then in the first half of 2025, they made $25 million of revenue. So that's indeed a big increase. And their gross margin percentage has also improved from negative 597% gross margin in the first half of 2024, and that has improved to negative 216% in the first half of 2025. And this is, and they're saying, oh, as we ramp up, our margins are improving. However, it's extremely misleading to look at the gross margins as a percentage for this company. So back in 2024, the revenue was extremely low, right? And they have their factory where they produce these zinc batteries. The factory itself has a lot of fixed costs, right? There are fixed costs just associated with keeping the lights on at the factory. And when you have a minimal amount of revenue, only $8 million, because they had the supply chain issues, so they were only able to produce a very small number of these batteries, the gross margin percentage is going to be, insane, like negative 600%. But that's just because you have these fixed costs, and the revenue is so low. Now, as you increase the revenue, the fixed costs are going to be absorbed over a larger amount of revenue. So your gross margin percentage is going to improve. And while that looks good in terms of having, a better gross loss in terms of the percentage, the reality is that currently their contribution margin is negative. So the contribution margin is revenue minus variable costs, because you have the factory, there's some fixed costs associated with just keeping the lights on at the factory, but then there's variable costs, materials and labor that will scale, somewhat linearly with production. And if your contribution margin is negative, meaning that the price that you sell the batteries for is less than the variable costs, that just means in dollar terms, the more batteries you sell, the more money that you are going to lose. And that is really the main problem with EOS, is that they have a negative contribution margin. And we can look here. So this chart shows their revenue, and then these orange bars are their gross loss. So over the past 2 quarters, revenue has indeed ramped up massively. It's like more than doubled over the past 2 quarters. But even as the revenue has increased, their gross losses in dollar terms have gotten worse. So and that's because they have this negative contribution margin. So they talk about, oh, it's an improvement in the percentage, and they're trying to spin that as a good thing. In reality, the situation is getting worse. So the more batteries they sell, the more money they lose. And if you have if you have negative contribution margins, you're never going to get to profitability, no matter how much you increase production. In fact, the more you produce, your gross losses in dollar terms are actually just going to get even worse. So the company in the earnings call, they tried to give some explanations as to why their gross losses are so bad, and how they plan to improve things. So this is an excerpt from the CEO in the earnings call. He said, "We did ship what I would call a very important strategic project that was at a lower price point. If you put that if you put that in the average price that we have in our backlog on those shipments, our sales would have topped out at over $20 million for the quarter. But the project that we're installing is very important for us to prove out the technology and to show that the things I talked about in the prior page work out in the field with a blue chip operator. So he's saying that they have this strategic customer, this so-called blue chip operator, and they sold some batteries to this blue chip operator at a discounted price. And had it not been for that discount, they would have made $20 million of revenue in the quarter. Now, in reality, they only made $15 million in the quarter. So they effectively gave a discount to this blue chip operator of $5 million. So there's a couple of things that are kind of suspicious about this. First of all, EOS claims to have a backlog of customer orders worth $672 million. Now, if you've watched our previous videos about EOS, we talked about why we think this backlog is mostly fake. But if you were to just take them at face value and that they supposedly have so much demand that they have $672 million worth of backlog of customer orders, well, if you have so much demand, why do you need to give a discount to some customer to prove that your technology works? You know, because these other customers who have already placed $672 million of orders, well, they already believe in the technology. That's why they were willing to put in these orders. Why do you need to prove the technology by giving a $5 million discount to this so-called blue chip operator? So that's already like pretty suspicious and, you know, raises some serious questions about the validity of their supposed backlog. And the other thing to note is that even if you do, you know, take their word for it and believe that they gave this $5 million discount to this blue chip operator, had it not been for that discount, their gross margin or their contribution margin would still have been negative. So in the second quarter of 2025, EOS's gross loss widened by $6.4 million versus the prior quarter. So the gross loss got $6.4 million worse. Now, $5 million of that is because of this discount that they supposedly gave to this blue chip operator. But even had it not been for that discount, their gross loss still would have widened by $1.4 million. So the contribution margin would still have been negative even had it not been for this discount. Remember, if contribution margin is negative, that means the gross margin, the gross profit in dollar terms is expanding. So this does not really, this alone cannot explain, you know, like even if you take their word for it, the situation is still very bad and their contribution margin is still negative. Now, they indeed have a plan to get to positive contribution margins by the end of the year. And here's what they say. If you look at gross margins, we've talked about get more volume over the asset base that we have and margins will come. You can see that clearly as the team gets more throughput through the factory, that gross margins are improving. We're going to transition to contribution margin positive cubes here as we get into the fourth quarter and targeting gross margin positive in the first quarter of next year. So he's saying that by the fourth quarter, they're going to start building. So when they say cubes, the batteries, they're like their batteries are like in these cube shaped boxes. So when he says cubes, he's just referring to the batteries that they make. So he's admitting that right now their batteries have a negative contribution margin. And in the third quarter, they're still going to have a negative contribution margin. But by the fourth quarter, he says they're going to have positive contribution margin. And then in Q1 2026, they're going to have positive gross profit overall. And how are they going to get to positive contribution margin? Well, the main way that they are going to improve their contribution margin is by implementing automation in their factories. So here you can see this picture. They have these robots, this yellow robot arm, and they're going to deploy these robots to assemble the batteries. And that's supposedly going to be way cheaper, because currently a lot of that is being done by hand by human workers. So with this new automation with robots, that'll be cheaper and that'll get them to positive contribution margin. That's what they're claiming. And let's read some more quotes from the earnings call where they try to explain how this is going to work. So you see the margin rates improving. We're going to continue that trend as we get through the year. Now, when he says the margin rates are improving, that's the percentage margin rates, which we explained why that's kind of a BS metric to look at. In reality, the gross profit in dollar terms, the gross loss in dollar terms is continuing to get worse. So he's saying it's an improvement. Yeah, it's an improvement in a percentage terms, but in reality, the contribution margin is still negative. So the gross losses are getting worse. That's a very, very important distinction to make. But I think that's really what we have to do, as we have to just keep doing what we've been doing, which is a doubling effect of production out of the factory. Now that gets you from like, I think you can get intimidated by the bump up saying, wow, doubling from where you are is not going to be tough. And we've been doing it without the benefit of the automation of our subassemblies. And that is starting to produce and feed the line. As we look at the capacity of the line has always been limited by the flow of parts that have come from our semi-automated subassembly processes. So he's saying currently they do not have full automation at their sub-assembly plant. As they get to full automation by deploying these robots, then their production rates will increase massively. They can increase their production, and that will supposedly get them to positive contribution margin. And as we bring online our sub-assembly automation, we'll start to approach that as we get to year end. And you'll see the company delivering the gross margins that are positive for the product that we put out into the field. Right? That's basically the same thing. We're going to get to positive gross margins due to these robots and automation. Now, later on in the earnings call, this is actually during the Q&A section, the CEO also gave the following statement. Yes, when you look at Q4 to Q1, Q1 to Q2, if you look at the page that we had in there, where we tried to mute out blah, 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 we're doubling production quarter over quarter for the last 9 months, doubling it again, double it again. And you're firmly in the middle of our guidance range. And that's what makes us feel like we'll get there. Now, inside of that doubling, I think there's a couple of things that everybody has to realize is like we doubled that production with the same production process, the same supply chain, and the same headcount. So that's very important. He's talking about, so over the past couple of years, so he's bragging about, oh, we doubled production in Q1, then we doubled production again in Q2, right? So they have indeed increased revenue a lot. And he's saying that they were able to achieve this increase in production with the same processes and with the same headcount, the same number of workers at the factory. So, I mean, during this period, they did not hire any new workers. They had the same number of workers, but they just produced more batteries, and that's how the revenue increased. Now, this exposes a problem in the narrative of how they're going to get to positive contribution margins. So, if we look at the numbers, we're comparing Q2 2025 versus Q1 2025. Right, so just look at the change versus the prior quarter. So in the second quarter, revenue increased by $4.8 million versus the prior quarter. Now, remember, they had that $5 million discount. So if we just give them the benefit of the doubt and remove that $5 million discount to look at, kind of the normal selling price that they say that they're going to achieve, had it not been for that $5 million discount, revenue would have increased by $9.8 million in the second quarter. Now, also in the second quarter versus the first quarter, their cost of goods sold, right, their COGS increased by $11 million. So the COGS increased more than the revenue, right? That's because of the negative contribution margin. So the gross loss got worse. Now, the COGS increased by $11 million. That means as they ramped up production, their variable expenses increased by $11 million. So what are those variable COGS? What do they consist of? Well, in general, you can break down, variable expenses at a factory largely into two categories: labor and materials, right? And they said that they did not hire any new workers, right? Their headcount remained constant. They did not hire any new workers in the second quarter. So that means that $11 million of increased COGS had to have come only from higher material costs. So that means the materials cost is greater than the price that they sell the batteries for. So if the materials cost are greater than the price that you sell the batteries for, you are always going to lose money. Even if they paid their workers nothing, they would still lose nothing. Even if they paid their workers nothing, they would still lose money because the materials cost is greater than the selling price, and we know that for the reasons I just discussed. So this whole narrative that they are going to get to positive contribution margin and then positive gross margin because of this factory automation and replacing workers with robots, this does not make any sense and is not gonna work because adding uh, adding robots does not reduce your materials cost at all. It only reduces your labor cost. So this whole narrative of how they're going to get to positive contribution margin is not credible at all. And another thing we should go over is just their crazy capital structure. So over the past few years, as EOS was losing huge amounts of money, burning huge amounts of cash, they did many dilutive capital raises that include both just selling stock and at the money offerings, but they also entered into a bunch of crazy transactions where they would issue convertible bonds and issue warrants and issue preferred stock that can convert into common stock and all this crazy stuff. So here on this table, we have compiled all of their various convertible bonds and warrants and preferred stock to try to calculate their fully diluted share count. So as of the end of the second quarter, they had 256 million common shares outstanding. However, they also have a bunch of convertible bonds. A lot of them are in the money. So if we look at the in the money convertible bonds, those will convert into, by the time they mature, those will convert into 82 million new shares. Plus, they have a bunch of warrants outstanding. And if we only look at the warrants that are in the money, that's another 88 million shares. Plus, they have issued a bunch of preferred stock that can convert into common stock, and that's another 116 million shares. So if we add all of their dilutive securities together, the total share count increases to 542 million shares. So really like more than double of their the headline number of their common shares. The real share count is actually more than double of that because of all these other crazy dilutive equity or these other crazy dilutive securities that they have issued. So if you just look on Google, Google tells you that the market cap is $1.8 billion. But Google only looks at the number of common shares outstanding. It doesn't consider all those other dilutive securities, the preferred stock, the convertible bonds, the warrants, etc. When you look at the real share count and calculate the real market cap, it's actually $3.7 billion. So because of the extreme amount of dilution, the valuation has actually increased a lot. So back in 2020, when the company first went public by merging with a SPAC, that SPAC deal valued the company's market cap at $550 million, and that was at $10 a share. So now the stock price is only $6.80 a share. So the stock price has declined since the SPAC transaction. But because the share count has increased so much, the market cap is $3.7 billion, which is an increase of almost 6 times increase from the market cap at the SPAC transaction. So since the SPAC transaction, the company's valuation has increased 6 times. This is despite the fact that the company has massively failed on all of its projections. Because when they first did the SPAC, they said, "Oh, we'll make like $1 billion of revenue by 2024." That was their original target. Now that obviously failed, and now they say, "Oh, we're going to make $150 million in 2025." That's their new target, and they're losing huge amounts of money, and their gross margins are negative. Their contribution margin is negative, and their plan to get to positive contribution margin is not credible. So this company is like a complete failure and a complete joke. Yet the valuation has actually increased massively. And I think one of the reasons for this is a lot of retail investors just look, oh, at the SPAC price, it was at $10. Now it's only $7. So I'm getting a good deal. I'm getting a good deal because the price is, lower than what it IPO'd at. However, most of these shareholders probably have not gone in and calculated the effect of all these, crazy dilutive securities that they have, and don't realize that they're actually buying in at an insane valuation. So that wraps it up for everything we had to talk about EOS today. Our opinion on the company still remains extremely negative. They're losing money. The viability of zinc batteries is highly questionable, given that lithium-ion batteries have gotten so cheap. And yeah, and then basically, as I explained previously, I don't see how this company is ever going to get to positive gross margins. So, as always, if you have any opinions, or thoughts about EOS, please let us know in the comment section below, and we will see you all on next week's video.